Hello and good morning everyone. So today is the first trading session of this week. So let's get started with today's top stocks and news. The first name is Interglobe Aviation, which is also known as Indigo. Despite higher than expected revenue growth, which is at 13.6% to 16,969 crore, the airline posted a significant net loss of 986 crore due to the rising cost and lower EBITDA margin, which is reported at 14.3% versus 16.4% last year. The result was a surprise. Basically, we are not anticipated because we have anticipated a much smaller loss. The next stock which you need to keep on your radar is IDFC First Bank, because the bank's net profit plummeted 73.3% to 200 crore despite a strong 21.2% growth in the net interest income. Asset quality issues intensified with gross NPA slightly rising to 1.92%, retail NPA increasing, and the slippages reaching a 13-quarter high. High provision and the declining return on asset signals are cautious times ahead. The next which you need to look at is Yes Bank, because the stable asset quality and a boost in the other income supported a net profit of 553 crores. NIS rose to 14.3% and the gross NPA slightly improved to 1.6%. However, the slippages increased by 9% and provisions, though lower by Y-on-Y basis, rose sequentially. The next stock which you need to look at is Coal India, because the net profit dropped by 22% amid lower than expected net sales of 30,673 crores. EBITDA margin, the realization per ton, was also down, impacted partially by a change in accounting policy of stripping activity. Despite challenges, EBITDA was close to target, showing the moderate operational resilience and the results. Now, the next stock which you need to look at is ICICI Bank, because the profitability of the bank is strong. Net profit at 14.5% on Y-on-Y basis, reaching to 11,745 crore. This exceeds the expectation, indicating the effective cost control and the growth in the core banking operation. If we talk about the NIS, because the bank core income from the lending activities grew by 9.5% on Y-on-Y basis, and it is surpassing the expectation, because higher NI suggests solid demand for loans and the good interest income as well. Now, if we look at the margins which show the bank profitability on loans slightly declined from 4.53% from 4.7% on Q-on-Q basis. The drop could be due to higher funding cost or change in the loan portfolio mix. Overall, if we see the ICICI Bank result, we can say the strong profit growth along with the improving asset quality and the robust loan growth. Basically, it is highlighting its resilience. However, there is a slight dip in NIMs and the CASA suggests increased funding cost on the pressures and the margins as well. Now, the another stock which you need to keep on your radar is Shriram Finance, because the company has announced its quarter 2 result. The first news is there is a stock split. The board approved 1:5 stock split, which means each share will be split into 5 shares, making them more affordable for investors and potentially improving liquidity in the stock market as well. The next point which we need to look at is the profitability of Shriram Finance, because it has posted 18.3 Y-on-Y increase in the net profit to 2,071 crore, slightly below the poll expectation, but still it's showing the solid growth as well. Now, if we look at the margins, the measure of the lending profitability was stable but slightly declined to 8.74% from 8.79% on Q-on-Q basis, which is also reflecting the marginal pressure on the lending margins as well. Overall, if we see the results, Shriram Finance strong net profit and higher growth alongside with slightly improved asset quality and an approved stock split showed its financial health and the commitment to increasing shareholder value. However, the slight decrease in the NIM and increase in the provision suggest a cautious approach to the risk management as well. Now, directly coming to the another stock, which is DLF, and company has showed its Q2 performance, where the net margin increased significantly to 1,381 crore from 621 crore Y-on-Y basis. and it is basically driven by the strong revenue growth and the deferred tax liability reversal. If we talk about the revenue, it is grown by 46.5% on YoY basis, and it is reported at 1,975 crore, which is also indicating a robust demand in the real estate sector. EBITDA, which is up by 8.6% on YoY basis, but at the same time, margins are declined to 25.4% from 34.4% on year-on-year basis, suggesting the higher operating cost or a shift in the revenue mix that affected the company's profitability. In summary, if we see the DLF result, DLF saw substantial net profit and the revenue growth, but its EBITDA margin contracted, indicating rising operational costs despite a strong top-line performance as well. Now, directly coming to the next stock is Torrent Pharma, because the company reported an increase of 17.4% of net profit on YoY basis, and it is reported at 453 crores, which is supported by revenue growth and the operational efficiency as well. Revenues also grown by 8.6% on YoY basis, showing a steady demand in the pharmaceutical sector. EBITDA rose by 13.8%, and the margins were also improved to 32.45% from 31% on the YoY basis. In total, we can say that Torrent Pharma achieved strong profit growth and improved EBITDA margins, highlighting a solid operational performance in a steady growth revenue environment. Overall, DLF also experienced a strong growth but faced a little bit of margin pressure, while Torrent Pharma delivered a strong profit gains and the efficiency improvements. So these are some of the stocks which you need to keep on your radar in today's trading session. Thank you. Bye-bye.